Most investors think building wealth in the stock market is about finding the single perfect ETF, the one magical fund that quietly compounds into millions while everyone else chases hype and loses money. But after studying decades of market history, I've realized something uncomfortable. The biggest gains usually don't come from picking the hottest investment. They come from understanding how different market environments reward different strategies. And that matters more now than ever, because going into 2026, the market is entering one of the strangest setups we've seen in years. Artificial intelligence is reshaping entire industries. Interest rates remain uncertain. Valuations in mega-cap technology are stretched, and investors are split between two beliefs. One side thinks the AI boom is only getting started. The other thinks we're already in the late stages of another technology bubble. Somewhere in the middle is reality. And that's why today, I want to break down 3 ETFs that approach growth, investing in completely different ways: SCHG, FDEC, and XMMO. All 3 have delivered exceptional long-term returns. All 3 are built differently, and all 3 tell a different story about where future wealth creation may come from over the next decade. Let's start with SCHG, because this is probably the easiest one to understand. SCHG is the Schwab US Large Cap Growth ETF. It focuses on large American companies with strong revenue growth, strong earnings growth, and dominant market positions. Think companies like Apple, Microsoft, Nvidia, Amazon, Meta, Broadcom, and Alphabet. What makes SCHG interesting is that it sits somewhere between the S&P 500 and a pure tech fund. It's aggressive, but not reckless, growth heavy, but still diversified enough to survive difficult market cycles. Over the last decade, SCHG has quietly become one of the strongest performing growth ETFs in the market. A huge reason for that is the structure of modern capitalism itself. The largest companies keep getting larger. Technology platforms scale globally faster than traditional businesses ever could. Software margins are massive. AI infrastructure spending is exploding, and dominant firms increasingly absorb market share from weaker competitors. SCHG captures a trend directly. Now here's where people misunderstand large cap growth investing. They assume the best years are already over because these companies are already enormous. But history actually shows that dominant companies can stay dominant for far longer than investors expect. Microsoft was considered too big years ago. Nvidia was considered expensive before another massive rally. Amazon has repeatedly been called overvalued for nearly 2 decades. Yet these companies continued compounding because innovation itself compounds. The more resources, data, customers, and infrastructure these businesses control, the harder they become to displace. SCHG benefits from that reality because it continually concentrates around the companies already leading the economy, and the numbers are impressive. Over long periods, SCHG has consistently outperformed the traditional S&P 500, a portfolio compounding at 16 to 18% annually instead of 10%. May not sound dramatic at first, but over 25 or 30 years, the difference becomes life-changing. A $500 monthly investment earning 10% annually grows to roughly $1.1 million after 30 years. At 18%, that same contribution schedule grows to well over $4 million. That gap is not small. It's the difference between retiring comfortably and building generational wealth. The math of compounding becomes absurd once returns stay elevated long enough. But there's a price for those returns. SCHG struggles when growth stocks fall out of favor. In environments where interest rates rise quickly or investors rotate toward value stocks, large cap growth can get hit hard. That's exactly what happened in 2022. Investors suddenly stopped caring about future growth projections and started demanding immediate profitability and lower valuations. Funds loaded with high-growth technology companies corrected aggressively, and psychologically, that's where most investors fail. Everyone says they want high returns until they experience a 25 or 30% drawdown. Suddenly long-term investing feels very different when your portfolio drops faster than you expected. That emotional pressure is real, and it's why understanding your own risk tolerance matters more than simply chasing the highest historical return. Now let's move to FDEC, because this ETF takes the growth story even further. FDEC is the Fidelity MSCI Information Technology Index ETF. Unlike SCHG, which still includes multiple sectors, FTech is almost entirely focused on technology. This is a direct bet on the continued dominance of the US tech sector. Semiconductors, cloud computing, cybersecurity, enterprise software, AI infrastructure, digital payments, data centers, automation. If those industries continue expanding globally, FDEC becomes one of the purest ways to benefit from that growth, and the performance has been extraordinary. Over the past decade, technology has dominated almost every other sector in the market. Investors who stayed concentrated in tech massively outperformed diversified portfolios. The reason is simple. Technology businesses scale differently than traditional businesses. A software company can add millions of customers globally without proportionally increasing costs. A cloud provider can expand margins as infrastructure grows. Semiconductor companies benefit from nearly every technological revolution simultaneously because everything now requires computing power. AI accelerated this trend even further. Suddenly, every major company in the world needed more chips, more servers, more data processing, and more cloud infrastructure. That wave created enormous tailwinds for tech-focused ETFs like FDEC. But concentration cuts both ways. The same force that creates explosive upside can also create brutal corrections. Pure technology funds are highly sensitive to market sentiment. When investors become optimistic about innovation, these funds surge. When fear enters the market, they often fall much harder than diversified indexes. And that's because technology valuations depend heavily on future expectations. Investors are pricing in years of growth ahead of time. If those expectations weaken even slightly, stock prices can reprice quickly. We saw that clearly during previous tech sell-offs. Strong companies survived, but investors still experienced painful volatility along the way. This is where long-term investing becomes less about intelligence and more about behavior. Most people underestimate how emotionally difficult volatility feels in real time. It's easy to say, I'm investing for 20 years during a bull market. It's harder to maintain conviction when headlines constantly predict crashes, recessions, or bubbles bursting. The investors who actually become wealthy are usually the ones who develop emotional discipline. They understand that volatility is not the enemy of long-term wealth creation. Panic selling is. Now here's the third ETF, and honestly, this one may be the most fascinating of all. XMMO, the Invesco S&P Midcap Momentum ETF. Most retail investors barely know it exists, which is surprising because its structure solves a problem that many growth investors ignore. See, both SCHG and FDEC are heavily concentrated in mega-cap companies. That means a relatively small group of giants drives a huge percentage of returns. XMMO works differently. It focuses on mid-cap companies showing strong momentum characteristics, not the biggest corporations in America, not speculative penny stocks either. Instead, it targets companies in that sweet spot where businesses are already established but still have meaningful room to grow. This matters because historically, mid-cap stocks have often delivered some of the strongest long-term returns in the market, large enough to survive economic stress better than tiny startups, but small enough to still experience explosive expansion. XMMO is a momentum strategy on top of that mid-cap exposure. In simple terms, it systematically leans toward stocks already showing strong price trends and improving fundamentals. And before people dismiss momentum as gambling, it's important to understand something. Momentum is one of the most researched market factors in finance. For decades, studies have shown that stocks performing well tend to continue outperforming for periods of time because institutional money flows, earnings revisions, and investor psychology often reinforce existing trends. What makes XMMO particularly interesting is its adaptability. Unlike pure tech funds locked into one sector, momentum strategies shift as market leadership changes. If industrial companies start outperforming, the ETF gradually tilts toward industrials. If healthcare gains strength, exposure changes accordingly. If technology remains dominant, the portfolio naturally increases tech weighting. That flexibility creates an important advantage in uncertain environments. Instead of trying to predict the future, the strategy reacts to what's already working. And honestly, that may become increasingly valuable over the next decade because predicting sector leadership is getting harder. 10 years ago, most investors didn't fully understand how dominant cloud computing, AI chips, or digital advertising would become. 10 years from now, entirely different industries may lead the market. Robotics, biotech, quantum computing, defense technology, energy infrastructure, automation. Nobody knows for certain. Momentum strategies avoid making giant long-term bets on one specific narrative. They simply follow strength wherever it appears. But again, there's a trade-off. Momentum strategies can experience periods of underperformance, especially during sudden market reversals. When leadership changes quickly, momentum funds sometimes lag while portfolios rebalance. They can also appear confusing to investors because holdings shift over time instead of remaining static. Some people prefer knowing exactly what they own permanently. Others value adaptability more. Neither approach is automatically right or wrong. It depends on personality and investing philosophy. Now, here's the question that matters most. Which of these ETFs actually gives investors the best setup going into 2026 and beyond? To answer that properly, we need to stop thinking only about returns and start thinking about market structure, because the environment ahead may look very different from the environment that created the last decade's winners. 4 years, megacap technology dominated almost everything. Low interest rates rewarded future growth. Capital flowed aggressively into innovation. AI accelerated the concentration, further because the largest companies possessed the computing infrastructure, data, and financial resources to capitalize fastest. But markets move in cycles. Eventually valuations matter, expectations matter, competition matters. That doesn't mean technology stops growing. It means future returns may become less straightforward. This is why diversification inside growth investing itself becomes important. Most investors think diversification, owning bonds or international stocks, but diversification can also mean diversifying growth strategies. SCHG gives exposure to dominant large-cap growth companies. FDEC provides concentrated technology upside. XMMO adds adaptability and mid-cap momentum exposure. Together, they behave differently under different conditions. Imagine a scenario where AI continues exploding, higher and technology remains unstoppable. FDEC probably performs best in that environment because of its concentrated exposure to the sector, benefiting most directly. Now imagine a scenario where tech valuations compress slightly, but strong companies across multiple sectors continue growing. SCHG likely performs better because of broader diversification. Finally, imagine a market where leadership rotates unpredictably between sectors over several years. Momentum strategies like SPMO could quietly outperform because they continually adapt instead of remaining anchored to one narrative. This is why I think investors often ask the wrong question. Instead of asking, which ETF will produce the highest return, the better question is, which ETF structure am I most likely to stay invested in for the next 20 years? Because consistency beats perfection in investing. The investor constantly switching strategies usually underperforms the investor following a solid plan imperfectly for decades. There's also another factor nobody talks about enough: lifestyle stress. A portfolio that keeps you awake at night is probably too aggressive for you. Even if it produces higher theoretical returns, investing success is not just mathematical, it's behavioral. If a 35% correction causes someone to panic sell, then the portfolio failed, regardless of long-term projections. The best allocation is often the one that balances growth potential with emotional sustainability. Personally, if I were constructing a long-term, aggressive growth allocation today, I wouldn't put everything into one ETF. I'd blend them strategically, something like 45% SCHG as the core large-cap growth engine, 35% XMMO for adaptive momentum exposure and mid-cap growth potential, and 20% FDEC for concentrated technology upside. That combination creates exposure to innovation while reducing dependence on a single market outcome. If technology continues dominating, the portfolio benefits significantly. If leadership broadens beyond megacap tech, the momentum and diversified growth exposure help balance returns. But if I absolutely had to choose only one ETF for the next decade, honestly, SCHG may be the most balanced answer right now. Not because it guarantees the highest returns, but because it captures the core drivers of modern economic growth without becoming excessively concentrated. It owns many of the world's strongest companies while still maintaining enough diversification to survive changing market environments. It's aggressive enough to outperform the broad market historically, but diversified enough that investors are more likely to actually hold through volatility. That last point matters more than people realize. Most wealth in investing comes from time, not brilliance. Missing just a handful of the market's best recovery days can destroy long-term returns. And unfortunately, those recovery days often happen immediately after crashes when fear is highest. Investors who constantly jump in and out of markets usually sabotage their own compounding. The people who win are often the boring ones, the consistent ones, the investors who keep buying during uncertainty instead of waiting for perfect conditions. Another thing worth understanding is that ETFs themselves are tools, not magic solutions. No ETF removes risk. No strategy works perfectly forever. Every investment style experiences difficult years. Growth underperforms sometimes. Momentum underperforms sometimes. Technology crash sometimes. The goal is not finding a portfolio that never declines. That portfolio does not exist. The goal is finding a strategy you understand deeply enough to continue holding when declines eventually happen. And honestly, that's why many investors fail with growth investing specifically. They misunderstand volatility. They think volatility means something is broken, but volatility is often just the price of admission for a higher long-term returns. The companies changing the world rarely move in straight lines. Amazon experienced massive drawdowns before becoming one of the greatest investments ever. Nvidia looked overextended multiple times before continuing higher. Innovation creates uncertainty by definition, because markets constantly struggle to price the future accurately. That's also why long-term thinking matters so much. Most headlines focus on what happens next quarter or next year, but compounding wealth happens over decades. A single bad year becomes almost irrelevant over a 25-year timeline. The problem is most people emotionally experience investing one day at a time, while wealth creation actually rewards patience across decades. So when people ask me which ETF is best, I think the deeper answer is this. The best ETF is the one aligned with both your financial goals and your psychological tolerance for risk. Some investors genuinely prefer concentrated bets because they can emotionally handle volatility. Others need broader diversification to stay invested consistently. Neither approach is automatically superior if both investors maintain discipline long enough. As we move deeper into the AI era, I think growth investing will remain one of the most powerful wealth-building strategies available. Technology is reshaping productivity globally. Automation continues expanding. Digital infrastructure spending remains enormous. Data, computing power, semiconductors, cybersecurity, robotics, cloud services, and machine learning are likely to influence nearly every major industry going forward. The question is not whether innovation continues. The question is which companies capture the most value from it and which Investment structures best position investors to benefit. That's why understanding the mechanics behind ETFs matters more than blindly chasing recent returns. SCHG, FDEC, and XMMO may all appear similar on the surface because they've produced strong growth historically, but underneath they represent completely different philosophies. One leans on dominant mega-cap growth leadership. One concentrates aggressively in technology innovation. One adapts dynamically through momentum and mid-cap exposure. Understanding those structural differences gives you a far better chance of staying invested intelligently when markets inevitably become volatile again. And ultimately, staying invested intelligently is what creates wealth. Not predicting every correction, not timing every rally, not finding the perfect stock, just consistently owning productive assets through long periods of economic growth while avoiding emotionally driven mistakes. That sounds simple, but very few people actually do it successfully because patience is harder than it looks when real money and real fear are involved. So before buying any ETF, ask yourself one honest question. If this fund dropped 30% next year, would I still hold it confidently? Because your answer to that question probably matters more than any historical return chart ever will.